In this video, I will be teaching you what no one has ever taught you about liquidity. Liquidity is referred to as one of the best trading strategies in the market. But, ever wondered why only a very few chunk of traders are making money with liquidity, while some are perpetually trying so hard to find their way around it? They say it's profitable, but you wonder why you are not making profits from it. All this is because of three things. There are three things that are keeping every trader stuck and unprofitable while trading liquidity. If you understand these three concepts that I'm about to reveal to you, you will start making money with liquidity. You will no longer find it hard to trade liquidity moves on the chart. But if you don't understand these three things that I'm about to reveal to you, you will keep repeating the same results every year, trading and trading without results. And no, I'm not about to tell you any fancy trading language, like other traders do. I noticed that these days, there is a name for every little move that the market makes. Talking about dynamic liquidity, elephant soup, motion liquidity, and all those other crazy stuffs, which leaves you even more confused than you were. Before you watch the video, I'm here to explain to you how the market really works, and the things that you must pay attention to when trading liquidity. But before we get to all of that, do well to like this video to show your support, and subscribe to our channel. If you are encountering us for the first time, now my tribe soldiers, let's get down into this business. To start with the first step, we will look at the overall liquidity movement. In liquidity, we have the internal liquidity and the external liquidity. When the trend is moving, for example, in an uptrend, the market will have to keep breaking the liquidity at the resistance zones in order to keep moving the market up. When the market keeps moving up and breaking those liquidity zones are called the external liquidity. And we don't want to trade the external liquidity unless on one scenario, and I will be explaining that to you very soon. Now, when you have little movements like this between the high and the last low of the structure, and then you have a liquidity sweep, this is called an internal liquidity. Everything that is moving here has a target direction, and the target direction is to take out the little liquidity movement there and move the market to the top. This is the part where the market usually reacts to an order block. More on that later. Now, in this internal liquidity, the market can also break the last low of the trend movement and still move the market further up. But at this point, the external liquidity have been activated, meaning that a trader can now expect market to fall when it hits the external liquidity zone. The popular name for this is called a change of structure, and that's the one many of you are familiar with, but in plain terms, we call that the break of the internal liquidity. This is the movement that activates the external liquidity. So now, there is more chances of the market selling from the resistance zone, just like it was buying from the support zones. Not like the market will majorly sell from that resistance zone. But if you see a great signal at the resistance zone, you can take a trade. But sometimes the market can break the internal liquidity and still break the external liquidity at the same time. This can also cause confusion in the market, but your end goal should be to trade based on the last break of structure. Number 2. The valid and invalid break of structure. Many traders don't know that the type of break of structure that they trade is the reason why they are not making profits in trading. While using liquidity trading strategies, the break of structure is very simple to identify once you are into liquidity trading, but not all break of structure are to be traded. Pay attention. This is very important. There are two ways a break of structure can appear, and only one of them is correct. You will know the correct one as we proceed. The first one happens this way. You will see the market moving in relative motion. As it is trending, you will see it break a structure, and after the break of structure, it returns to the internal liquidity, touching the same zone that it just broke the structure, then break another structure, fall back to the internal liquidity, and so on. This market movement moves more like a good trending movement. Now, there is another break of structure. This type does not move like the other at all. After breaking a structure, it does not return to the internal liquidity or zone where it broke the structure from. Instead, it breaks another structure and sometimes keep repeating the same pattern over and over. And when it happens like this, there are two ways that it can affect the market. The first thing is that it can signal the end of the trend. Most times when this happens, the market ends up changing trend direction from the former direction to a new one. The movement could also be short sometimes, but it has a great effect on the chart to that point, meaning that if you had a zone that you have drawn out before this occurred on the chart, and by the time it returns to that zone again, there will no longer be strength to move the market from that point, leading to more losing trades or half target price movements, and most times it can keep making the movements continuously, giving traders no chance of entering the market. Anytime you see this type of break of structure in the market, you should be warned. Do not trade it. Now you know the sheep from the goat, that this second move is the wrong one, the kind of break of structure you should avoid. Always go for the first type of break of structure, the type that always close into the internal liquidity. This is the one that will bring you profits in the market. Now, onto the final liquidity concept, the third concept that many traders get wrong all the time. This is the most confusing to many traders, as it is always misinterpreted. This is the reason why many people find it hard to trade liquidity, as these concepts are always given a new name every single day. And like I said earlier in this video, it is not about the names given to the concept. It's about the understanding of how the market really works. This third thing is about the best areas to draw out your liquidity zones. Open the chart of many liquidity traders, and you will see so many red boxes that it almost looks as though every candle has its own box. But you will be surprised that with all those lines, they are still not profitable. In order to become profitable trading liquidity, you should not trade like them. You need your charts to be cleaner. Your zones must be precise. And the only way to get about that is to target the base movements. There are many ways to trade liquidity, but the best way to do it is to look for zones that appears at the beginning of a price movement or at the beginning of a break of structure. This is the area we call the base. And there are also many ways we draw out liquidity zones at the base. For some traders, they can draw it using the first candle at the base of a break of structure. And for some, they can draw out a base candle at the base of a break of structure. And for others, they make use of concepts like the fair value gap to get a liquidity zone, although many of them look for this liquidity zones around different price levels in the market, which is wrong. Drawing them randomly on the chart, just because you are able to see them, is not the right way to trade. You need an area of target, the area where price is most likely to come back to, and gain the strength to move the market to your desired target level. And the best place to do this is the base. Like I said before, the base is the beginning of a price movement, and since we are trading with liquidity, we mostly trade with the breakout structures. So the beginning of a break of structure is our base movement. I want to be as plain as possible, just in case a beginner in liquidity trading is watching this video right now. My aim of making trading videos is to explain trading in such a way that even a beginner trader can be able to understand them and grab all the concepts. So whether you are a trader that likes to trade with a first candle, or you are the type that wants to see a strategic base candle, or you are just the type that likes to trade with the fair value gap, always make sure that you are drawing them out from the base of the break of structure. Do not draw them at the middle zone or further than that area. Make sure that all your strategic signals are drawn out from the base. This will help you to make more money from the trade, instead of randomly drawing them from anywhere on the chart. Now, these three concepts are the major keys you need to become a profitable trader in liquidity. If you follow them, you will see an astonishing type of result on your chart. much better than everything that you used to do before. Many traders will try to complicate trading, but I will always make everything easy on this channel. If you're a beginner in liquidity trading, and you don't even know anything about liquidity, or you want to start from scratch again, in our next video that will appear on the screen right now, I will be simplifying everything about liquidity trading, from the beginning to the end, in such a way that even your dog can understand. See you there, my tribe soldiers.